Good afternoon, everyone, and good morning to our friends in the West. My name is Ken Weldon, and I hope you're all well. On behalf of Martin Matthews and myself as Joint Heads of Audit at PKF, please allow me to offer you a warm welcome to our 2021 financial reporting update. It's great to see well over 250 registrations for this event, and we're wondering if we'll break 300 during the session, which might be a record for us. So, clients, contacts, colleagues and friends, you're all very, very welcome. As I do so, I'd like to acknowledge the traditional owners of the lands in which we're all meeting around the country for the session. I am sitting in the land of the Wurundjeri people of the Kulin Nation, and offer my respects to the elders past, present and emerging, recognising that their sovereignty was never yielded. So I guess at this time last year, we were all in the midst of that unprecedented uncertainty facing us as a nation, as players in local and global markets, and as finance professionals looking to a year end where completeness, valuations, accuracy had possibly never been more of a challenge. Today, as I mentioned, I've talked to you from Victoria, where we are now back monitoring case numbers, scrutinising patterns and considering if we will be conducting another year-end close in a remote environment. Fingers crossed that we are not. I wrote that last night, but wishful thinking, giving everyone's news this morning. So I have my mask and my PKF stress ball. So wherever you are, stay safe and please follow the advice of the experts. I mentioned that in our introduction because we know for many of you around the country, COVID may not be front of mind. However, whilst we have other topics to discuss in this update, it does remain an elephant in the room. And whilst it may not be as acute for some of you as 2020, it's still a feature that we cannot ignore as we enter the strategy June reporting season. As recently as yesterday, I participated in a call alongside our first guest with the heads of audit quality and audit leaders from the other national network firms. And whilst respecting the Chatham House rule for that meeting, I can share with you that the view of ASIC is that for the 2021 year ends, they are still paying very, very close attention to the ongoing narrative, commentary and disclosure around COVID. Bit more of that later. So as we move to our first session of the day, I'd like to introduce and welcome Liz Just, Managing Director of Qualitas Consultants. Liz is PKF's retained audit quality advisor and all-round guru on contemporary financial reporting practices. So good afternoon, Liz.
Thank you, Ken. And
hope you are well.
I'm well, and I hope everybody on the call is well.
So look, in tackling this first session and without the headline of any brand new accounting standards, it may be tempting to think that it's a quiet year, nothing to see here. But as we all know, the devil is in the detail. So Liz, I'm wondering if you could share with the group, I guess, the renewed expectations from the preparer's perspective around perhaps accounting estimates and other things which they should have front of mind at this time.
Yeah, look, thanks, Ken. I think the whole issue of accounting estimates is a very interesting one. And I think for those people on the call that are, those charged with governance or sitting in a finance role, I think what hit the press last year in terms of the Freedom Foods restatements of somewhere in the veracity of $580 million written off their balance sheet. Of the $580 million, $580 million of it was in relation to accounting estimates. So to me, that's a pretty major reminder of aspects of judgment where things can go very, very wrong. And it's interesting, as effective from the 15th of December 2020, the audit fraternity have a new auditing standard around auditing accounting estimates, ISA 540. Those of you who would like some entertainment, perhaps tomorrow night on a Friday night with a glass of wine, please feel free to read it. The amusing thing for you as clients and companies associated with PKF is that there's an acronym now within that standard that possibly will make you laugh. It's called MAD. Now, I know auditors have been deemed mad for a very long time, as Ken smirks, but what MAD stands for is methods, assumptions, and data. So you're going to have a dialogue with your auditors this coming time, probably for the first time using those acronyms. And if you think about it, that's essentially what you guys have been doing for a very long time now, in the way you actually accumulate your accounting estimates. So I think it's really important to potentially think about, as you're coming to this 30th of June and this new auditing standard just sort of hits the road here in Australia, I think it's really important that you think about that acronym. What methods am I applying? Are they appropriate to the accounting estimate? What assumptions underpin the accounting estimate? And what data am I using? And I think we need to challenge those within our organisation, and particularly up to the board level, making sure there is an understanding of the types of accounting estimates that you have within your organisations as you head into this 30th of June. So there may be a bit of an education, and I think you'll find that the dialogue from an audit perspective is going to slightly change, would be my perspective of that one, Ken.
Yeah, thank you. And certainly, I wouldn't want anyone listening to that to think this is just an auditing issue. It's certainly the context within which we are now required to conduct our audits is equally as applicable to the preparers and indeed the executives and the directors who are signing off the financial statements. So, as Liz suggests, the estimates are management's estimates. They're not necessarily ours. We're here to audit them. So this is a focus for everyone, and certainly those of you who perhaps don't have a fully documented set of accounting policies, a fully documented set of accounting estimates and judgments, now is the time to perhaps dust that down. And certainly, whilst we can't write them for you, we can certainly guide you as to what the standard is now looking at. So please be aware that that's for everyone. And outside of that, Liz, I guess just in terms of the other regulators that we have, whether it be ASIC or ASX or even ACNC, for those on the call covered by that, I guess what's recently on their mind. And you know, I know that you and I were recently at a forum where Kathy Armour, the ASIC commissioner, spoke. So what's on the regulators' mind?
Well, I think what we'll probably see this 30th of June, if we cover off ASIC first, I think what we'll see this coming June, and certainly it was indicated on the call that both Ken and I were on yesterday, that the areas of focus from ASIC at 30th of June 2020 will be similar to that. Sorry, 2021, I should say. I don't want to go back to last year, that's for certain. Will be very similar to what you saw at December 2020 and June 2020. So, but as Ken alluded to, the comment was very, very strongly put that there will be a continued focus on the narrative around COVID, and I think certainly the feeling out there is that there's still going to be a considerable amount of focus on going concern aspects, and that probably we'll see this 30 June 2021 with a high degree of focus on that area now that things like JobKeeper, etc., have finished. So it's going to be an interesting time. I think the other areas that ASIC is certainly focused on is cyber preparedness of companies, and narrative in financial reports around that. It's the other area that we know that they've got some very strong dialogue on is in relation to climate, and particularly those companies that certainly in the oil and gas sectors in particular they're really looking at the types of disclosures and narratives around climate. The other thing that the other point that's worth raising is, you know, there's a lot of dialogue at the moment around remuneration and the levels of remunerations, particularly in the publicly listed company space. So that's another thing that I think need to be focused on this 30th of June. Questions, I think, from shareholders around the level of remuneration, given the 12 months that we've just, or 18 months that we've just been through.
Yeah, look, again, on those 2 points of cyber remuneration and climate change, for some of you who may think that doesn't really affect you, and it may well be that you don't require a disclosure certainly from an audit's perspective, we have to be seen to be asking that question. So when we have our files inspected, as is part of life, if we are silent on those topics, then that's where it becomes difficult. So again, you may find that we're having some discussions and questions around those topics this time round. Doesn't automatically mean that there's a disclosure, but certainly we need to be showing that each side of the table is having an awareness of that issue and a robust discussion of how it may be impacting before, during and after 30 June. Just closing, Liz, anything from the ASX and ACNC worth commenting on?
The ACNC doing some changes to their governance statement number 3. So if you're in that space, you need to be aware of what's happening there. The other thing I would say from the ACNC's perspective, I mean, they've worked very hard on their website, for example, and as a regulator's website goes, if you're in that space, it's very informative and it is very helpful for preparers of financial statements as well as auditors. So if you're in that space, I can't talk highly enough of that particular website. They've done some reporting of late in terms of reviews of financial statements. And those of you that are in the charity space, you need to be aware of, it's going through government at the moment, but there's a change in the sectors, so that, you know, there are now going to be, I think, 6,000 or 8,000 charities that won't have to do the level of reporting that they did, say, 12 months ago. So that's the other thing there. APRA's not a space that I'm an expert in, so I won't talk to any of the APRA related changes. With the ASX, don't forget that there are a number of their governance standards that changed effective 31 December 2020. So if you're not aware of what they are, you may go again onto their website and familiarise yourself with those changes.
Excellent, thank you.
The one final thing though I'd make, ASIC are being, I'm seeing it across the board, ASIC are being a lot more active at the moment in asking companies questions about their financial statements. And again, linking back to the Freedom Foods situation, all the questions that I'm seeing from my clients where ASIC are talking to them, all of them, those queries are around the accounting estimates. So just to, you know, ASIC is being very active in that space. I mean, arguably they have been for a while, but I'm just seeing more and more of it now.
Oh, excellent, thank you, Liz. Many thanks for now. We look forward to hearing from you from the course of the session. I'd like to turn to a couple of audience questions by poll, which by the wonders of modern technology should soon appear on your screen. I'm looking for a nod to suggest that's the case, but certainly I guess we're interested in getting the mood of the room and understanding to what extent you're feeling more confident in your financial reporting processes this year compared to this time last year, given the year that we've had. So give you some time to have a look at that question. Once you've answered that, if you click on the next button, there's then a second follow-up question, which comments on that question of cyber. We mentioned that earlier. So again, interested to what extent within your organization you have increased your focus on cyber matters. Is it a significant increase? Is it moderate? Is it the same, or even is it less? And I'm interested on your views there. I asked that question on cyber. It does remind me of the audit where we did assess the strength of the system password protocols and found that in this particular organization, most people were using the password, also the word fortnight as a password. So we did give them the obvious conclusion that that was too weak. And I'll leave you to laugh at that one while you fill out your answers. So hopefully the answers are coming through. Yes, Liz.
Ken, we've got a question from the audience. So while people are filling in their answers, I thought I might add. So the question is, what type of questions of accounting estimates are ASIC focused on? I think clearly it's in relation to the assumptions more than methods. And it's also around sensitivities as well. So, you know, if you've got, you know, price dependent changes type things, you know, what degree of depth, etc., that the companies have gone into in terms of determining what their assumptions are and the reasonability of those assumptions. I know Doug Niven, for example, at ASIC has been very public in his view. You have to look back to look forwards. So another thing is making sure that the forward-looking position does not look, you know, obscenely different from how a company's been tracking historically. So they're sort of the main areas of focus that I'm seeing ASIC on that. So I hope that answers your question.
Yeah, that on a more granular level, that boils down to, I guess, the sales forecast that you're putting in your budgets for impairment models, the CPI rates that you're putting there around your wages. For those of you who get wages, you know, as a key determinant of your model, I think we're all experiencing a degree of wage inflation within our markets at the minute, through to the discount rates. Outside of impairment, it can cover, you know, your expected credit losses on debtors, your provisions on inventories. So I guess all those classical accounting judgments and estimates, which pretty much match up against all the AASBs. So look at your balance sheet, look at your P&L, where have you applied the accounting standards? It's pretty likely you've made a judgment and estimate in applying those standards, and that's essentially what is fair game for us, obviously us to audit, but obviously ASIC to ask the question if something attracts the attention.
The other thing that I know ASIC have been focused on is to ensure that when you're using a value and use model, for example, and using a discounted cash flow, that AASB 116 has been taken into consideration. So that is your leased assets and your value, your right of use assets, etc. So if you haven't already built those into your models, you need to.
Yeah, absolutely. That's a bit of a sleeper, and certainly anyone that's not come across that, please reach out to your PKF team and we'll guide you through that. Certainly that was one which we picked up during the last reporting season. So thank you, Liz. Thank you everyone for the questions and the poll answers. I'll now hand you over to Hayley Keagan, who's PKF's National Technical Director, to guide us through the next session. So over to you, Hayley.
Thanks, Ken, and thanks, Liz. That was some really good insights there. Welcome everyone to this year's financial reporting update. I'm really pleased to be back again and being involved in this. So today I get the pleasure of getting to interrogate one of our audit partners on your behalf to ask them the questions about what you need to know about getting ready for this year's reporting season and audit season. So today I get the pleasure of interviewing or asking questions of Kim Riley, who is an audit partner from our Sydney firm. Kim is a chartered accountant and registered company auditor. She's got more than 10 years experience. I've had the pleasure of working with her over these 10 years as well. She works across external audit and internal audit and has experience in a range of industries. So welcome, Kim.
Thanks, Hayley. Looking forward to the interrogation.
Okay, hopefully it's not too bad. But Kim, one of the areas that continues to interest me is AASB 16. We're 1 year on now from implementation, and just from your perspective as an audit partner, I'm interested to hear what some of the things are that you're seeing out there that accountants and preparers should be wary of when they go to prepare their lease calculations ready for audit.
Yeah, sure. Thanks, Hayley. Look, when the standard first came to effect and on implementation, I think the big one for most of my clients was the sheer volume of leases that it captured. Looking at all those contracts that when we initially asked them, do you have any operating leases that potentially will need to be brought onto balance sheet? The answer was, oh, we might have a couple. And the number of clients that when they looked through all their contracts and licensing agreements, the volume of individual leases that met the definition of a lease under AASB 16 was huge in some instances. 1 year on, and looking at our 31 December clients that are now at their second year of reporting for leases, I think the big one is around modifications to leases, looking at any CPI changes, discount rates, and changes in overall lease terms, which happened across the board with most clients through COVID, and making sure that they're prepared and able to account for those modifications. I found a lot of clients had some type of model that they'd use for calculating leases under AASB 16, but often those models weren't able to account for those modifications, and that's when they became a little bit unstuck. And in some cases that resulted in delays in the audit process, delays in finalisation. So getting on the front foot in terms of lease modifications, having those discussions with your auditors before 30 June, and making sure that the model that you're using is able to account for that appropriately is really important.
Yeah, right. There's a lot going on there. I feel like AASB 16 is the standard that just keeps on giving. It's not necessarily set and forget. We have to keep going back and visiting it. So it's interesting to see you're seeing it the same throughout your audits. So now just reflecting on some of the things that Liz was mentioning, particularly about mad auditors and the idea of having the estimates and getting ready for estimates. As an audit partner, what would be your expectations in terms of clients preparing their estimation documentation ready for audit?
Yeah, I think as Liz stated, the onus is on us and the standard is for auditors. However, that doesn't mean that there's not a lot of work that needs to go into it from the client's perspective. We're going to be asking the questions. We're going to be challenging those assumptions, the method, the underlying data, or the MAD acronym, as Liz referred to. But in doing so, clients need to be prepared for those discussions that we're going to be having. They need to have that documentation ready. Again, try and have those discussions before 30 June, because you should have a reasonable estimate, a reasonable idea of what those assumptions are going to be at 30 June, even in the earlier months, and being ready and being on the front foot. We've always had to audit estimates, but the level and degree of assumptions and challenging that we have to do in terms of those discussions is increased this year. So just being ready for that, having all your documentation ready, doing your own stress testing around any key estimates as well. If you're preparing discounted cash flows, if you've got some value in use assumptions, making sure before your auditor comes out, you're stress testing that yourself, so you're ready for those discussions, I think is what's really important. Yeah,
that's some good advice. Preparedness is key, particularly around those tricky areas like estimates. There's so much that changes from year to year. So something else that I've seen around in financial reports mentioned is talking about the results of the Rosado case, and this is defining what is actually a casual employee. So in your experience, have you come across this, and how has it impacted your audit procedures, and do you have any advice out there for those who might have casual employees on what they should do?
Yeah, definitely. At 30 June, I guess last year it was a bit of an unknown, and it still is because the appeal hasn't been handed down for the Rosado case. But in saying that, we've been encouraging all our clients to consider the impact of this case if it is the ruling is to go ahead, and how that would play out for them in terms of the financial statements. So what I saw last year was really an increase in clients around disclosure for the contingency. Where they could calculate what the impact would be, we would encourage them to do that. Where they couldn't, at least putting as a minimum, putting in that disclosure around the contingencies note of what that potential liability could be. Liz, I can see you popped on. Did you want to comment on that one as well?
Yes, at this infamous two people secret meeting that Ken and I were at yesterday, we were talking about this exact topic, and I think there is a lot of confusion. You're 100% right, Kim, and there's actually been a change to the Fair Work Act around this, and around you can't double dip in terms of if you've paid a loading, etc. So I think you're right. We need to, for those companies that this is relevant to, and it potentially could have a material impact, you need to get an understanding. But I think this is something that we could go back to this community on probably before 30th of June, because we're seeking some clarification with ASIC on this particular point and their expectations around what they're wanting to see come this 30th of June.
Yeah, my only other comment there, guys, is just to the extent where you think this hasn't been an issue for you in the past. I'm sure many of you are in the same position of us, where there's a shortage of labour, there's a shortage of skilled employees who you'd like to bring into your business. Therefore, if you're thinking laterally, you may actually have exposure to this casual element for the first time. So I guess it's a question that we'll be asking, because all our clients, it may not have been an issue before, but to what extent do you have people who meet these characteristics within your workforce now? And therefore the risk of having to pay attention to this. So again, another example of something that just suddenly changes within the dynamic, which we just have to remain alert to. But it's a good point, Hayley, to keep front of mind.
Yeah, thank you, everyone. It's definitely a lot of confusion out there. It'd be great to see some clarity soon, and hopefully we'll understand exactly what is casual employees. So I've just got one more question for you, Kim. Hopefully it's an easy one. But it's just generally, have you got any advice for financial report preparers on how they can best prepare for audit if they're under audit, and how to allow for a smooth audit process?
Yes. Look, the audit's usually staged over a number of phases. So making sure that you're ready in terms of documentation, in terms of your policies and procedures for each of those phases, and doing that well in advance. We're finding that clients are often liking us now to stage the audit over potentially 4 or 5 phases and doing bits and pieces as they have the information ready, which is great. Obviously, the July, August, September period is always really busy for us for 30 June clients. So where clients can have that information ready before that allocated week and let us know, we're able to start working on that, which will make the audit process faster. We've got here just a bit of an image in terms of the audit process and how we like to phase our audits, with planning interim before year end and finalisation and reporting. In the planning stage, I think it's really important to really assess whether you're ready for your auditors to come out. If you're not, to let them know sooner than later, because there's nothing worse than the auditors coming out and you not being ready and then having to reschedule. So having that conversation early, if you need to move things around, is really important. Looking at your accounting policies and accounting estimates, I've already gone through that, making sure that you're across all your accounting estimates, that you've got all of those work papers and assumptions ready to discuss with your auditor. Also consider going concern as well. That's something that we need to look at the planning, interim, finalisation and reporting stage. So you need to look at that as clients. Consider going concern, consider your cash flow forecasts and your budgets. Are they appropriate? Hold those discussions with your auditor all along the way. Then when it comes to interim, again, just making sure your documentation is ready. Do you have your budgets prepared? Do you have your board minutes available? And what we really try to do there is understand your systems and processes and looking at your internal control environment. So if you do have any documented policies and procedures, making sure that they're across to us and that you've gone through those and you've updated it. If there's been changes in staff, that you've updated the policies and procedures where they need to be updated. Your delegated authority matrix, if you have one, hopefully you'll do, making sure that's up to date as well. Obviously, over the last 12 months, I think a lot of clients have seen changes in their workforce and changes in those key personnel that might have had delegated authority at different levels. So making sure that that's still appropriate. That's something that we'll definitely be looking at. And then in terms of finalisation, like I said, if you can have information ready before that final week, talk with your auditor about what you think you might be able to have ready. There's a lot of reconciliations that if your audit's scheduled in August or September, you could potentially have ready mid-July. So having a conversation with your auditor as to whether they're able to start working on bits and pieces beforehand. They might not be able to, but if they can, it might just make the process smoother. And when that dedicated week is, or 2 weeks, whatever the period is set, making sure that you're ready well in advance of that. It's really important also to make sure you have one central person within your company that's liaising with the auditor and keeping up to date and keeping control of what's going on and the discussions and information requests. That way it just keeps it all in line and it becomes less messy, and it's a more efficient process for both you. You're able to continue as business as usual, and also for the auditor as well.
Okay, sounds like preparedness is key. Be prepared. Sound like I'm back at Scouts, but it seems to be a common theme for this this year. The more prepared you are, the better it'll go. Now I believe you got some poll questions that you're going to ask the audience, and while the audience is answering those, I encourage everyone to submit any questions you got through the question box within Zoom, and Kim and I and Ken and Liz will also do our best to answer those.
Okay, thanks, Hayley. So the first question is around how you're feeling about your upcoming audit. Are you excited? You're not expecting any issues? Are you confident, but there will be some issues? Are you anxious, or are you really stressed? Interested to hear your feedback of what you're expecting, and hopefully we can talk you through some of that, or hopefully we've put you a little bit at ease and not scared you too much from the discussions we've had previously. And the second one is how you're feeling about seeing your audit team face to face. This one's a really interesting one for us at the moment. We're finding some clients are really happy to have us back after last year doing the audit remotely and struggled doing the audit remotely. And then other clients are saying, actually, that worked really well for us. Can we continue? We don't want you sitting in our offices. The way that we communicated with them last year worked really well, and they want to continue doing that. And then other clients, it's a bit of both. They like to see us for a couple of days, or they like to have conversations with those key personnel from the audit team that they need to, but not necessarily have a whole audit team sitting out on site for a whole week. So yeah, interested to hear your feedback on that. All right, that's pretty good. Most people are pretty confident, but there will be one or two issues. That's what we want to see. I can't see down to the next one.
So it's come up with 42% of people, they do appreciate seeing you guys and your smiling faces, but they do don't mind having a bit of a hybrid, so where you're kind of on site for some of the time and do a bit of the work in the office as well. That was followed by 32% of people who really enjoy seeing the audit team and their smiling faces on site, so that's good to hear as well. And then we had 11% for those who prefer the off-site arrangements, and 16% that just prefer whatever gets the audit done the best way.
Yeah, that's good to hear. So it looks like a bit of everything. I think where we're engaged on a client for the first time, it's really important that we're out on site where we can be to have those discussions face to face, build that rapport, get to know our clients. But the clients where we have had the relationship for a longer period of time, a combination works really well as well.
Okay. So I'll just have a look if there's any questions. All right, so we've been asked if we can get a view via a survey on how many people think AASB 16 has added to or detracted from the usefulness of financial statements. I don't have a poll prepared for that one today. Oh, here we go. We do. There's another question here. I'm interested to know the answer to this one, because AASB 16 has just got a lot of interesting areas to it. Hey, Ken,
Yeah.
how you going?
I think as you're considering that, I suspect the question is slightly loaded, which we completely understand. I guess as you've possibly heard your audit teams sharing with you over the last 18 months, this is a don't shoot the messenger one. There is obviously with this accounting standard, so I guess acknowledging that it's the international board who set this standard, and many of you have heard the story when it was triggered by the then chair of that board sitting in a plane. I think he was in the Hong Kong airport, sitting in a plane, wondering whose balance sheet this piece of machinery belonged to, and then concluded it wasn't sitting on anyone's balance sheet. That's what triggered this whole discussion and ended up with this standard. Whether it's ended up achieving greater transparency in the statements, and certainly we have anecdotal evidence from banks who would say, give me financial covenants, we're going to back out the results of the AASB transition, borne out with I think what's come up with this survey. So I guess thank you to the questioner. I think that's common with other experiences when we go around helping clients with this standard. But remember, don't shoot the messenger. We have to guide you. We did right.
I'm hopeful that with time we'll get used to the requirements, and our systems will be set up to appropriately handle the tricky things like the lease modifications, so that it'll hopefully add to the value in the future. But I do think there's a long road ahead as we still start to get used to it, and there's still some teething issues with AASB 16. Okay, so we haven't had any other questions come in, so looks like it. Kim, thank you very much. That was very thorough and very helpful. I wish you best for
All right,
this.
thank you. It wasn't too onerous.
I wish you the best for this upcoming audit season. I hope it all goes smoothly for you, and you still get to see some of your clients out on site and do a bit of off-site work as well.
Thanks so much, Hayley. Thank you, everyone.
Okay. So now I get to go on with some technical areas. So I've got 3 topics I'm going to be talking about today. First of all, I'm going through the Payment Times Reporting Act. And then secondly, I'll be touching on, sorry, I'll get my screen to work. Second, I'll be touching on some of those lease issues that we've come across. So looking at the lease modifications and how you can best prepare for them, or how you can keep an eye on if there's going to be issues coming up. And then finally, just talking briefly about the removal of special purpose financial statements, which is coming up from the 1st of July 2021. So getting straight into it, the Payment Times Reporting Act. So this act, it commenced on 1 January 2021, so it's in place now. The idea of it is that it's going to impact big business only. It's not intended to affect the small businesses. And it's going to collect data from these large businesses, which will then be made publicly available on what's called a Payment Times Register. So those businesses that are going to be required to report their payment terms, they'll have to do that twice a year. So the idea is it's going to include information on how long, on average, does it take your business to pay suppliers. And then those smaller businesses will be able to log on to that Payment Times Register to be able to understand that and then make decisions about who they deal with for their business, or even understand how long it will take them to get paid so that they can manage their cash flow appropriately. So they're hopeful that it will create a bit of an incentive to pay the smaller businesses quicker, because the information will be out there for everyone to see. So who does it impact? Well, it's large businesses, as I said, but there's an income threshold as well. So if you're a single entity and you have $100 million of income or more, you will be required to report. Or if you're a consolidated entity, a group entity, with $100 million or more, then that head entity will need to report. And in addition to that, any subsidiary of a consolidated entity with the 100 million or more, any subsidiary that's got a $10 million income will also need to report. So it's not just on a group basis, but they'll have a look at the individual subsidiary basis as well. Now that income is determined not by accounting standards, but actually by taxable income. So what goes on the tax return. And you refer to your most recent income year to find out if you are required to report. Some of the difficult areas is not in terms of determining the income or that group area, but more so in applying the definition of what businesses are included. So the legislation refers to constitutional corporations. That means a business that's incorporated under law in Australia. It will include foreign businesses, it'll include government entities. It can include some businesses that operate in a territory if they're in a trust situation, because generally a trust doesn't meet the definition of a constitutional corporation, but it will do so if it's in a territory, or it will do so if it's got other requirements, such as listing requirements or other reporting requirements. So some trusts, but not all trusts. It excludes charities. So that definition, it's not, it's a little bit tricky. It's not easy to work out. So if you are concerned that whether you need to apply the constitutional corporation definition, or if you're worried about whether your business is included, or even part of your business, if you have a trust that's included in your group structure, please reach out to us. We'll help guide you through that. So if you do work out that you have to do the reporting, if you have to lodge this stuff for the Payment Times Reporting Act, you'll need to do it every 6 months. So the report becomes due 3 months after the end of the reporting period. This legislation started on the 1st of January. So our first reporting period is 1 January 2021 to 30 June 2021, nearly finished. And then that first report will become due on the 30th of September 2021. Then if you need to submit your report by way of a data portal. It is in a data form, so it's not just a form that you fill out and you lodge. you will have to upload a CSV file or an Excel file with the appropriate data. So what does the data include? It's designed to receive relevant data about your small business suppliers and their payment terms. So it's going to be aggregated data about the business's payment terms and how long they've taken to pay each of their suppliers. It'll include other information about your business, such as what industry you work in and how you procure your suppliers. There will need to be a signature as a declaration by someone who's a responsible member of the business. But in gathering this data, we're focusing on small businesses. So you want to collect the payment terms for when you've been making payments to small businesses. So to help with that, there is a tool that's available online. It's called the Small Business Identification Tool. So how this tool works is that you can upload all of the ABNs of all of your suppliers, and then it'll return to you which ones are considered to be small businesses. So then you can take that information with your data and then make sure you're only extracting the payment times for those businesses that are considered small businesses. So there's a fair bit of data analytics work that's involved in this. It's only simple, like you can do this in Excel, but it's not just a form that you fill out, it is actual data that you will be lodging. So the kind of information that's in there, in this data that we actually lodged, it's got the standard payment period. So that's calculations based on the actual payment days for when you've been making payments to your small suppliers. A summary of small business invoices that have been paid, and that'll be disaggregated by payment days. So disaggregated by how long it takes you to actually pay them. And then the value of procurement from small businesses compared to all procurement, just to get an idea of how many small businesses you actually deal with. And then any other information that might be relevant, such as whether you're providing finance arrangements, because that might skew the days in which it's paying, or if there's prescribed invoicing terms, or if there's progress payments going on there. So all that kind of information is going in there so that we can determine the average days it takes to pay, and then the small businesses can make decisions whether to do business with your company based on that information. All right, so that's the Payment Times Reporting Act. I'll take questions at the end of the session. Feel free to pop them in the question box and I'll revisit it at the end. I will come back to it. But for now, moving on to AASB 16 implementation and some of the issues that we're seeing there. So after we've implemented AASB 16, it's not set and forget. There's ongoing requirements that we need to look at. So some of those areas would be where we have new leases, where we have terminations, where we have reassessments or modifications. So in particular, if you have a new lease versus modification of existing lease, because it may be the same lessor and you may be renting out an additional room, you need to go through to consider whether that's a new lease or whether it's a modification. Other things that are going on is this year there were COVID-19 rent concessions that were allowed. So understanding what the implications of that and how to account for it is important. And then whenever we're making any changes, such as lease modifications or reassessments, understanding whether we need to adjust the discount rate or the implicit interest rate and what the appropriate discount rate is. And then also reassessing lease term options. So what I'm talking about there is if you have an option to renew your lease for, say, an extra 10 years or so, just considering exactly what the implications are of you reassessing that option, or the intention to take up that option or to not take up that option. So all of these things can cause a few headaches when we go to do our lease calculations. Now looking particularly into lease changes themselves, this is where we could, we've got all our lease schedule set, but during the year things can happen that's going to change that. So if we've got a new lease, what we do there is we just account for it as a new lease. From the day that we're able to use the underlying asset, that's the day that we take up the new lease. And then we'll have to use a discount rate as at that date. So we're going to need to be continually assessing this discount rate every time we take up a new lease. So it should be reflective of the borrowing ability at that date that that new lease starts. So that's pretty simple. I think we've got familiar now with setting up new leases and how they work. But then we also have to think about lease termination. So if all goes to plan, when the lease terminates, it'll be at the end of the lease term, and hopefully we've already expired all of our assets and we've recorded all of our interest on the liability, and it'll just net out to zero. But that's not always the case. So sometimes we're terminating leases early. And if that's the case, then we need to consider how to account for that, because it's likely going to be a profit and loss impact. Now, the profit and loss impact isn't just on a termination fee, should there be one, but also on the difference of the carrying value, the right of use asset, and the lease liability. So at the point that the decision's made to terminate the lease will be the point in which we may have a profit and loss impact from that. Now getting down to lease modifications, which is the trickiest area, I believe. So we have a lease modification where we're either increasing or decreasing the scope of a lease. And when I say scope, I mean the underlying asset which we're using. So in the example of a building, we'll be increasing our scope if we were to lease out another floor, or we'd be decreasing it if we were to reduce the floor space we're going to use. So where that's happening and then the price is changing in proportion to that, we have a lease modification. And there's a two-step process that you need to go through for this. So first of all is determining the profit and loss impact. So as at the date that the renegotiation occurred to either increase or decrease that lease scope will be the date in which we'll have to have a profit and loss impact. It can be a gain or it can be a loss depending on how that negotiation went to change that term. Then the second step is after that, we need to adjust our discount rate. So need to assess what our current borrowing rate should be, adjust that to the right of use asset and to the lease liability, but not having a profit and loss impact on that. So this is where it can get tricky because there's a few models out there that don't support these kind of modifications because we need to basically reset our right of use asset and depreciation and our lease liability and interest using that new discount rate. So some other changes that can come out would be reassessments. This is different to what lease modifications are. So reassessments are where we're reassessing the future lease payments because there might have been a change in the CPI rate or a change in any other rate that's stated in those existing terms. Or it could be that we are either deciding to take up a future option or deciding not to take up a future option. This is called a reassessment. So when we do a reassessment, we only update the discount rate if we're reassessing that term of the lease. So we'll do the same thing for step 2 of a lease modification where we will recalculate using the new discount rate and then only have an adjustment to the asset and the liability. No profit and loss adjustment from that. If there's any other kind of reassessment, such as a change in the future lease payments as a result of CPI change, that does not affect the discount rate. So you still maintain that original discount rate from the start of the lease. So they're the 4 types of lease changes that can occur. So lease is definitely not set and forget. And each of these changes, you need to do those calculations as at the date of the change. So it's not something that you wait to the end of the year and then go do your lease calculations and update it and hope for the best. You do kind of need to be monitoring it constantly because there's always changes that can occur during the year. All right, so this is just something else I wanted to touch on is the lease term. So the lease term, it can change depending on options. And what we're looking for is enforceable rights. So the first lease term that we look for is the period in which the lease is not cancelable by either party. So that's nice and simple. We know that lease term and we can see that neither party can exit from the lease. But then when it gets a little bit tricky, when we have a look at where people have got options, termination options or extension options. So we need to look at whether that option lies with the lessee or with the lessor. So if it's lying with the lessee, then we need to go and apply some more detailed guidance as to whether that extended term is likely to be exercised or not. So lease term, it's not just the start of the lease date and the end of the lease date. It is also for any other options, but it can even get trickier again when we have undocumented lease terms, such as leases that are between related entities. Because we don't have the documented end term, we need to look at other indications of how long that lease is. So the example I use in this case is if we have one business that owns the land and then we have a fellow subsidiary that built the building on that land, well, then that subsidiary that built that building on that land would probably expect to be leasing that land for the life of the building. So that would be an indication that that lease term is the useful life of the building. So those kind of things get really tricky. There is guidance in the standard. It's down in the B section paragraphs in AASB 16. So if you go to B37 to B40, it gives some things to look at to determine the lease term. It is tricky if you've got one of these undocumented leases, or if you're unsure about, I do encourage you to reach out, because it is very difficult and there's a lot of judgment that's going on there. All right, COVID lease concessions, they came around. That was great. So there was you had the option that if you had a reduction in your rent payments and that they didn't have to be repaid later, and that those that reduction was received prior to 30 June 2021, that you could use this relief. If you didn't use the relief, you'd have to account for it as a lease modification, which I went through just before, which can be a bit tricky. So conditions for using the relief is that the rent reduction payments, they should have been received before 30 June 2021, and that there's no other changes to the lease terms. So provided is just simply a rent waiver, we can use this. What it means is that you can account for the reduction as if it's a variable lease payment, which means you just kind of go debit lease liability for the amount that you should have paid and credit other income. If you don't do that, then you would have to treat it as if it's a lease modification and go through that process I mentioned before. So this only applied to lessees, not to lessors. Okay, so I'll be really quick on this, just talking about special purpose financial statements and removal. If you currently prepare special purpose financial statements, I encourage you to get a copy of these slides and go through this flow chart. It's also in our fact sheet, just to find out whether you're going to be impacted. I can say straight up that not-for-profits won't be impacted, and that anyone who doesn't have a requirement to lodge financials or a legislative requirement for lodgement, they won't be impacted. But if you are a for-profit entity, if you do lodge with ASIC, this should definitely be on your radar. I encourage you to have a look at this slide if it affects you. So that's just a list of those entities who aren't impacted. So how are you going to prepare if you are impacted? Well, what's happening is that from 1 July 2021, you won't be able to prepare your special purpose financial statements anymore. So that's going to affect you for 30 June 2022. Instead, there is a new standard available, which is the General Purpose Financial Statement SDS. So that's a replacement, but it does require that you have to do consolidation and equity accounting, which some businesses might not have been doing previously under special purpose financials. The other thing that you'll need to do is you'll have to comply with recognition and measurement in accordance with all accounting standards. So not all businesses have done that previously. I've seen businesses which have chosen not to adopt AASB 16 because they're preparing special purpose financials. Well, if they're affected by this change, then they're going to have to start getting ready for AASB 16 or anything else that they might have missed previously. So it's a good idea to consider if you're impacted, and if so, there's some transitional relief that you can take advantage of before it expires. Now, before I go through that transitional relief, I got Liz there. You want to pop in and have a chat about this one?
I just think if you are in this space, and there's a lot to learn, because it's as per usual, the AASB have not made it easy for anyone to understand. But if you previously have not consolidated, or you previously have not applied equity accounting to your special purpose financial statements, I strongly advise that you take up what Hayley is about to tell you. That would be my absolute advice to you.
Yeah, thanks, Liz. Yeah, strong advice there. I'm really for this as well. There is transition relief if you transition now. Now, this transition relief is only available if you go ahead and transition early instead of waiting until the mandatory date. Now, what this relief does, it's for your comparative balances. So I've just got up on the slide here the balances that you would be showing if you were to take up the relief. So you would be showing your balance sheet and profit and loss of your 30 June 2021 balances, but your comparative for your balance sheet would be 1 July 2020. What that has the impact of doing is meaning that you don't have to do a consolidation for the period from 1 July 2019 to 30 June 2020, because you're only doing the opening consolidation at 1 July 2020. So it can really help if you're a first-time consolidator or if you're first time putting in that equity accounting adjustments. So then what happens with the profit and loss? It'll show the balances as at 30 June 2021, which has got your full consolidated or your equity accounted amounts in there. Then the comparative figure will be the 30 June 2020 balances that were in your previous special purpose financial report. So if those balances were previously just the single entity financials, that will all you'll be showing for that comparative balance. But then for the 30 June 2021, you'll have the full consolidated amount there. So that is if you use that transition relief. And just remember, that's only available if you are to early adopt. So you have to do it at 30 June 2021, otherwise you miss out. And this is what you'll end up having to do if you transition later. So you'll have to do full retrospective adjustment, which means you'll have the 3 columns on your balance sheet. So you'll have to do the opening balance at 1 July 2020. You'll have to do your comparative balance at 30 June 2021. And you'll have to do your balance sheet at 30 June 2022. It means there's a lot more consolidation adjustments to do because you have to go right back in time, particularly when you go to calculate things for your cash flow, because you're going to have to do your consolidations right back to be able to get that comparative cash flow. So a fair bit of work to be done there. If you are, as Liz said, if you are moving from doing single entity financials over to consolidated, or you doing equity accounting financials, I strongly encourage you to jump on this transition relief. Hey, Ken?
I was just going to cheekily suggest again another one that we didn't write, so don't shoot the messenger, but certainly worth giving serious consideration to in the next 35 days or so. Could save you a bit of effort in the long run. So to the extent you haven't had this on your radar thus far, now's a great time to be chatting to the team.
And I've just got one little comment here about if you are continuing special purpose financial statements, you do have some extra disclosures you've got to put in now. So for 30 June 2021, you'll have to put in disclosures about why you're doing special purpose financial statements, the extent that they comply with recognition and measurement, and the extent of any kind of consolidation, or if you're not consolidating, an explanation as to why and who the controlled entities are. So if you need more help on this, there's some fact sheets there that you can use. There's some AASB webinars, which are really handy, and that'll help you understand the requirements and what's involved. So I've put links to those there. For those of you that are in Newcastle and Sydney, we're running some workshops. So feel free to register your attendance of that or express your interest in attending. They are limited because they are the face-to-face ones, so they're workshops which are going to be interactive, or reach out to your advisor as well for help on this. So that's the topics that I had for today. Now I'm just going to check out if there's any questions there.
Just while you're checking, Hayley, it's probably worth noting it's not often that I will say that the AASB's webinars are interesting and good, but on this topic, the first 2, which would be relevant to the audience here, are actually a very high quality and very easy to follow. So if you're in this space, I strongly recommend that you view those online.
Okay.
Good, thank you, Liz. Look, just Hayley, just conscious we're up against the hour, which was the allotted time. I think it's 7 or 8 questions there on the Payment Times Reporting Act. So what I think we might do is gather those up with the audience's permission and just send around some thoughts and some further links for further reading to those, because yeah, there's quite a few there. So that's a topic which perhaps has been a bit of a sleeper and has crept up on all of us. So let's take the time to respond to those in an appropriate manner, if we may. Yeah, so look, I guess just up against the hour, unless anyone's got any immediately burning questions, or please continue to populate them in the Q&A box. I guess look, on behalf of Kim, Liz and Hayley, who did all the heavy lifting for this, and the team in the background, Jemiah and Sarah, who make this look seamless. Look, thank you very much for giving us your time. It's great that you're part of the PKF community. I guess one lesson out of recent events is let's just keep communicating. Communicate early, communicate often, and communicate clearly. And together we will get through this reporting season, whether it's in person or remote or as a hybrid. But thank you for your attendance and look forward to staying in touch over the coming weeks and months. So thank you.